Hey, welcome everybody. I'm Ted Earhart. I'm sure it's no news to you that we are living through an extremely low environment with respect to interest rates. In fact, if you think about the post World War II era, which is generally considered the modern era for finance and markets and so forth, I mean, globally, interest rates, without question, are at the lowest levels ever. This has had some unintended consequences. It's put a lot of savers in a tough position. People that have traditionally relied on things like CDs, municipal bonds, savings bonds, etc., have really been forced to take more risk in their portfolio in effort to find any return. I mean, as I record this, the 10-year government bond, so you have to put your money, commit your money for 10 years, that is yielding less than 1% today. And basically, all the other instruments I just mentioned are right in line with that. So it creates a very difficult situation for people who are looking to save money without much risk or no risk in their portfolio. Naturally, we therefore get this question occasionally, well, aren't there some, safer stocks, dividend paying stocks, blue chip names? And what about these low volatility funds that my buddies on my bowling league or whatever are telling me about? I want to talk a little bit about this today because it's a question we get on a somewhat regular basis. So whenever I hear someone mention the word safe and stocks in the same sentence, I always say, whoa, time out. In my opinion, there's really no such thing as a quote unquote safe stock. And first of all, let's define what people are talking about when they use the word safe. Well, what they really mean in the context of this discussion, something that has price stability, something that doesn't have the big ups and downs of the stock market more generally. I think it's just natural. People intuitively think that, big, well-established companies that have been around, for decades and have diversified business lines are generally more quote unquote safe. Well, to completely destroy that notion, for the last 10 years, I've been showing people this table. Here's 20 companies, basically the bluest of the blue chip names you can possibly imagine. And we're looking back during the period surrounding the global financial crisis, 2007 and 2009, and look at what happened to the stock price on average, or this is the individual stock prices, how they were impacted during that period. On average, they lost about 55% of their value during this period. So, I mean, would anybody possibly consider that safe? I think the answer is, self-evident. In fact, the stock market broadly was down just about 55% during this period, 2007 to 2009. So you always got to think about this very cautiously. And, that brings me to this second segment of these so-called low volatility or minimal volatility funds. This is a product, if you will, or a solution that some of the major financial institutions have been kind of promoting over the last 5 to 10 years. And I've looked at them very, very skeptically because of what we're looking at in this table here. If you are any student at all of market history, I mean, you have to know that whenever someone says, well, I can deliver, stock market like returns without the volatility, you got to look at that very cautiously. So, but of course, because of the low interest rate environment, this idea is attractive to people. And I just want to take a minute to kind of show you how it performed earlier this year when we had the big sell-off due to the pandemic. So let's take a look. Here is just a handful of these supposedly low volatility funds, which are supposed to be less volatile than the stock market broadly. Here's the couple months surrounding the big market sell-off that we experienced in February, March of 2020. I'm going to zoom in specifically on this period, which, the stock market peaked on February 19th of 2020, and it bottomed out less than 6 weeks later on March 23rd. So let's take a look at this. Here in purple, which is the second one down here, the stock market was down just shy of 34%, peak to trough. And again, here's these four. I just kind of picked these randomly just by doing a little bit of Google searching. But four big names, probably companies you've all heard of. And take a look. Again, it's kind of, I shake my head and basically look at this and say, well, my skepticism was totally verified. I mean, all of these funds, which are supposed to be less volatile than the market broadly, were down as much or even more than the stock market as a whole. Why does this happen? Well, basically, I mean, it's pretty simple in a couple of respects. In financial markets, when the tide goes out, in other words, when there's panic, like we experienced in March and like we experienced during the global financial crisis, there's basically nowhere to hide. People just indiscriminately sell, and even the biggest, most established companies are not immune to these big fluctuations that occur. If you look throughout history, definitely every 10 years, the stock market takes a big hit because of some event, whether, it's a pandemic or a financial crisis or a stock market bubble like we had in 2000. These things, they actually occur somewhat regularly, and there's no place to consistently hide. So when you're thinking about where you can generate a safe rate of return, and you're asking this question, well, maybe I'll put my money in dividend paying stocks, or, if someone pitches you a low volatility fund, I mean, go in to those with your eyes wide open and knowing that there are no perfect solutions. In other words, if someone tells you they can deliver you stock market like returns with less volatility, be very, very careful about it, because, historically, there's been no magic formula that's been able to consistently produce that, and there never will be. And the reason for that is, if there were, everybody would figure it out. And once everybody started doing it, it would no longer work. It's, I'm in Minnesota, and it's kind of a lot like fishing. If there's a lake that's hot and everybody's catching fish, well, sooner or later, everybody finds out about it. Everybody starts fishing it, and all of a sudden the opportunity disappears. And the same thing is true in investing. If a strategy is working, inevitably it will quit working once more and more people find out about it. So that's just a quick one for you today, as we all work through the challenge of investing in a low interest rate environment. You got to be very, very careful, because people are always trying to offer something that sounds too good to be true, and as investors, the greed factor gets in and can often cloud our judgment. So as always, thanks for tuning in, and we'll see you next time.